Morning, Preston.
Hey, good morning.
Morning, James.
Good morning.
How are you both?
Fantastic.
Needing coffee?
Yes.
Thank you for the coffee.
Thank you for the early show.
Thank Danny for that. Actually, I've been up since 5:30.
That's not bad. 5:30.
Not me.
I didn't go out to play last night.
Got it. 5:30.
You don't say half.
No, well, we'll say 5:30.
Okay.
Yeah.
Sorry.
I didn't even understand what you said.
5:30 means 5:30.
I was just like, oh, whatever that is.
I haven't done my American Duolingo yet.
Wait till you go down south.
It's tricky.
5:30.
5:30. Welcome both. How you been?
Been great.
Don't know when did I see you last?
Was it Nashville?
I don't know, man.
Yeah, Nashville.
Yes,
it was
Nashville.
Nashville, yeah.
We were talking about BlackRock.
Where are we?
Yeah. Did I last see you in Bedford? Or no, Miami?
I feel like, no, Miami. Yeah.
It's like every few months we get to hang out now.
Yeah.
There's so many events.
So many events.
Do you remember what we spoke about a year ago?
No.
You don't?
With Foss.
With Foss.
Oh, yeah. That was fantastic.
Yeah.
We talked about there was a debt problem coming.
Yeah. Well, you retweeted that recently again because when we were preparing, we were looking. Always, you look through people's Twitter, see what they're talking about, and we saw your retweet of it again.
Well,
was it a pin tweet?
You know what happened? Yeah, I had pinned it. What had happened was back in July, August of last year, Greg and I were having a conversation. We're talking about the debt, and he's like, "You should probably write something about the debt spiral." I was like, "Yeah, it's probably a good idea." And then, I wrote that. People were like, whoa, wait, what?
Yeah, what?
How does this work? Yeah.
So I was going through that this morning, and I hadn't realized that was the one you written a year ago. I thought it was recent, and I got down to the debt clock, and I was like, "Oh no, that's wrong."
Yeah.
Because it was at like 30.7
Exactly.
trillion, and then I looked at the date. And I was like, "Oh shit, this was a year ago," and we're at what 3 trillion since. Here we go.
Oh yeah. Well, here's the interesting part. What's great about this is this is a great website, the usdebtclock.org. But they're using all of the data that's coming from the CBO and the Treasury here. So they're just pulling data from actual government sources, right? So this isn't just made up. And you can see all the way in the top left, $33.5 trillion. Well, here's the crazy thing. We crossed 33 trillion just about 2 weeks ago, just over 2 weeks ago. So we've added $500 billion of debt in 2 weeks.
That's half the GDP of the UK.
How are we doing?
I think isn't our GDP about $1 trillion?
I don't know.
1.1 trillion, I think the UK GDP is. You added that in 2 weeks, half of it.
Yeah. Well, we added the entire market cap of Bitcoin in 2 weeks. Yeah. How's that? So, but the whole premise of that thread was that we are spending far more than we're making. So we would be, if the U.S. was a company listed on the New York Stock Exchange, it would be called a zombie company because we're not covering our interest payments. So our interest payments, here's the best part, is that last year when I wrote that thread, the interest payments were like $600 billion. They're now approaching $1 trillion.
See, if this was my personal finances, my house would probably be foreclosed on.
You very soon.
Yeah.
You wouldn't be able to pay your credit card debt.
Yeah.
And you would be taking out more credit cards, and those interest rates would just be going higher because you're okay. So this is what we talked about last year.
Yeah, I know. And we're going to revisit it because I think it's worth it.
Okay. Well, I mean, the bottom line is
we're fucked.
The punchline is, yeah. Well, the whole point was we had compared. I compared it to like a single parent who was just trying to keep up, right?
Yeah.
And you and I talked about this. I think we talked about this at length, Preston and I, almost daily. But the bottom line is it's like you're a single parent, you're trying to keep up. You've got your mandatory expenses, okay? So you've got your mortgage, your car payment, the food for your kids, all right? And so you've got to gas for the car, you've got to make these payments. And if you don't, then you're kind of screwed because you either lose your job, you lose your house, right? So you've got to, but you're not keeping up because of inflation. So what do? You take out a credit card and you start, charging things to credit card. Well, of course, you're not keeping up because you're in a negative earnings position. So now you're taking out, you fill up that credit card, and then the interest payments on that credit card are so high that you start paying the interest payments on that credit card with another credit card and paying on your mandatory expenses. And it goes into a spiral where you just can't get out of, so you literally go bankrupt, right? Yep. So, but the problem is as your credit gets worse, the interest on the credit cards that you're offered is higher. So it makes it even worse. It just compounds it, right? So, and we said,
some people won't even lend you money.
Exactly. So we said yes. And so we said last year that you get to the position where people won't lend you money and they're going to charge you a higher interest rate for it. And that's what's going to happen to the U.S. debt when we get to a point where people realize, oh God, this is not stopping. They're going to have to issue so much debt that I want a higher interest payment for this. I'm not going to lend them money at 3% for 30 years. I want 5, 6, 7%. And here we are.
Or like when I was in Argentina a couple of months ago, they're offering 150%.
Yeah, well, that's hyperinflation, which we could get to.
I don't think it's hyperinflation yet. Hyperinflation is 50% a year.
Yeah, that's an academic.
Yeah.
Yes, that's an exactly.
But
that's an academic definition. It's ridiculous. So,
okay, yeah. But my interest in this really is that, and I think the reason we have to revisit it is because lots of people listening to the show, they like Bitcoin, but they tend to tune into these conversations more. It's really a macro show. We call it What Bitcoin Did. It's a macro show.
Yeah.
And we know that because we'll get you two on and there'll be like 80, 100,000 people listening. We could get Nick Szabo on, it'll be less. So we know, and Nick Szabo people love, but we know that people want the macro because they're like, this is the shit that affects me right now. How bad is it? And what do I need to do?
Yeah, because it's affecting your personal finances and the future. And the future of Bitcoin.
And having, in the last few months been out to both Argentina and Lebanon, where I've seen very high inflation in Argentina and then seen a country which has effectively collapsed in Lebanon, where the currency isn't worth shit. It's used as change, actually. So when you go into Starbucks, you buy a coffee and you get your $12 change, you'll get 10 in dollars and the $2 in the lira. They use it for change. And the only people actually using it are government workers now. And they're, I could tell you so many stories, but essentially they just put a new law in place. People who work for the army can get a second job because the money they get paid is worth shit. And so I've always been of the belief that hyperinflation is something that happens in developing economies or other parts of the world that you hear about on the news, and it's never really going to come to the UK. It's never really going to come to the US. But actually, we spoke about this in the UK. I mean, we talked about one of the ideas is that you could run triple-digit inflation to wipe out the debt. And so I think the reason it's important to keep covering this is, you're the experts. Where are we? How bad is it? How bad could it get? What's the time frame, and what can people do? They're really important questions.
Yeah. Well,
to your point on the credit card example with the rates going higher. So when you look at the last year, we've seen inflation pull back, but yet you've seen treasury yields across the entire duration of the yield curve continue to go higher.
Right. Let's define that first. That inflation pull back. We still have inflation. It's just not
disinflation.
It's not as bad as it was, but prices are still inflating. Yeah. So sorry. Yeah. That's something that
that's an important term.
The government wants to confuse you on that. They say prices are going down. No, they're not. The rise, the rate of rise is going down, but it's still rising. So go ahead.
Yeah. That's a super important point.
Let me add to that. That's where our Prime Minister, Rishi Sunak, has been gaslighting the British people, because he's been saying, they asked about tax cuts recently. He said, he said a very honest thing about inflation. Have you seen this? Actually, this is wild. Get this up. Yeah. But he did say also that I want to bring down inflation so people have more money in their pockets. I was like, hold on a second. If you bring down inflation, they're not going to have more money in their pockets. They're still going to have less money in their pockets. It's just at a decreasing rate, but you're still going to have less money because you've still got inflation.
Yeah.
And that was a fucking lie.
Yeah.
And I was like, are you lying, or do you not even understand it yourself?
It's the same exact thing that we had with our press secretary here. She was gaslighting us, and they just refused to answer the questions. They just keep pointing back to, it's getting better.
Watch this. So this is some wild honesty.
Is a tax. It's a tax that impacts the poorest people the most. And that is why the best tax cut that I can deliver is to halve inflation.
Well,
and that's why I set it out as the first.
Let's not have
economically, the
debate.
impact that it has on people is to eat into their pockets. It eats into their wallets. It puts up the prices of things. It effectively acts as a tax. And that is why we must bring it down. And that's why we are, and the plans are working.
But my question to you, Prime Minister, this morning is about the impact of the changes that you have been making. And you're explaining that you think they're the right things to do. And you're basically saying, bring it on to your critics. But on the one specific, your close colleague, Michael Gove, this morning has said that you should commit to cutting taxes for working people before the next election.
So she's trying to argue in the background. I don't know if you heard her. She's saying, but inflation is not a tax. And the Prime Minister is saying, yes, it is.
It is.
Yeah.
And so now he's kind of being honest.
Yeah. It's interesting.
Yeah.
It's interesting.
Which is wild.
Well, but I want to hear what else Preston has to say.
Preston.
No.
I disrupted you.
I find it crazy that the BBC's arguing on the opposite side of that. That was crazy. And James's point is really important. So you have disinflation, which means the prices are still going up. They're just not going up as fast as they were when they were 8% annually. But when you're looking at the yield curve and you're seeing it continue to blow out, the yields are going higher, which means the prices are coming down. You would typically see that if inflation was rising, you would see that behavior in the fixed income market because everybody would be trying to adjust and have some type of yield on top of that inflation rate, or which is really kind of your keystone that you're trying to outpace, or your hurdle rate is whatever that inflation rate is. So the fact that we're seeing that continue to sell off is effectively the example that he provided with the credit card, where the rates keep going higher because they're getting to the point where James wrote this article a year ago or whatever it was. And it was kind of like, oh yeah, look at this guy over here. He's some Twitter guy.
A macro extremist.
Look at this. Bitcoin.
I had so many people come into that thread and just say, you're out of your mind.
You're out of your mind.
Like, you're exaggerating. Oh, you're exaggerating. And then
Luke Roman told me,
math, right?
Luke Roman told me, he goes, it's not just some random Bitcoiner and some guy from Cincinnati talking about this debt spiral anymore. He says, it's everybody on Wall Street. It's like very credible people talking about what James highlighted a year ago, that the math isn't working anymore. And this is looking like we're crossing the event horizon and there's no return.
Well, Caitlin Long said this to me 4 years ago. She said, is it even longer?
I'm not sure.
4 or 5 years ago, I made a show with her and Safedine, and she was like, they're running out of bullets here. Mm-hmm. And I don't know when it's going to hit, but it's going to hit. Mm-hmm. And I mean, Foss has been saying it for like 2-3 years.
Yeah.
He just says, it's math.
Yeah.
It's math. That's all it is.
Here's the best part. Danny, scroll down to the bottom there.
Oh, they've got an amazing new mobile app.
Up to the right there in the bottom red. This is the real problem.
Yeah.
So that's what the government really owes. It's got $195 trillion of unfunded liabilities.
Hold on. 195 trillion.
Yeah, because
what?
That's what we owe.
The promises. So like this is
promises.
accounting for the promises of
Social
Security.
Yes. And Medicare, Medicaid, and all that. Yeah. Yeah.
Over what time period is that really?
That's got to be about 30 to 50 years.
Yeah, I'd say so. Yeah. So you'd have to do like a discount. You'd have to discount it back, but then like what discount rate are you using to figure out what the?
That's everybody. That's every worker. It's all in there.
So that's $6 trillion a year.
Yeah. But still, now then if you bring up the chart that with the gold chart that I did not do this research.
The Treasury chart.
Yeah. And this is the problem. This is where we're headed because of all of this. Now, I don't know if it's going to be 2036 because he's backing into that number through debt doubling every, 8 to 9 years. We're 33.
The M2's compounding at like 7 to 8%, right? Yeah. So it's at 10 years, you're going to double. That's a 10-year double rate, right? Mm-hmm. So
I mean, explaining this to people who are listening and not on YouTube, it looks like around 19.
Yeah, I think that's accurate.
Well, if you think about it, in about 2025 or 2035, 2032 will be at 66 or 70 trillion dollars of debt.
Well, I was going to go back a step. So this chart looks at about 1971. There was about 2 trillion of debt, and by 2000, that's about 5 trillion.
I mean, at the end of the day, it's log. Like you're dealing if the money is compounding it from the M2 standpoint, right? If we look at M2 and we do a compounded annual growth rate on M2 over the last 10, 20 years, or whatever period you want to use, it's around 7 to 8%. So when you're dealing with that, this needs to be in log. This is in linear terms. So that's why when you're looking at things like before 1980, it looks like a Bitcoin chart, basically, because you're dealing with compound.
It's hockey stick.
Yes.
Yeah. But here's another important part about this is people will comment, yeah, but this doesn't matter. You have to look at GDP against it, because if GDP is just as high, then it's fine, right? Well, it's not going to be, because GDP is not growing at this rate. It's growing at a slower rate, much slower rate than debt now. And, the problem is you're not going to be able to cover this with earnings without what? Inflation. Period. You need to inflate, because you're not going to have enough productivity, natural productivity, to keep up with this pace of debt creation. So you absolutely must have a high rate of perpetual inflation, which is not 2%. So even if the Fed drives down, we go through a recession. What is going to happen if we go through a recession? Well, our receipts. Right, our tax receipts are going to fall. They're already down.
They're already down.
They're already down 10%.
That's the crazy part. Yeah. They're already down, and we haven't even got into that part of the cycle yet. And so can you imagine what they're going to be when you do get into the depths of that?
So what will they have to do? They'll have to create money. So they'll have to print money to come into the markets and shore them up and make sure that GDP doesn't fall dramatically off a cliff, because then tax receipts will fall, and this number will only get worse faster.
So this is the yo-yo. They bring down inflation into a recessionary period. Tax receipts are lower, so they're going to have to create money. They're going to have to stimulate markets. They'll flood the market with money, which will lead to more inflation. They'll raise up interest rates. Is this the perpetual cycle?
This is the perpetual cycle, but I want to highlight a key difference on this one that we're in right now. So everybody's familiar with Silicon Valley Bank, right?
Yeah.
So if they would have taken their hands off the controls and they would have let Silicon Valley Bank fail, you would have immediately had this massive deflationary wind that would have swept through all the markets, right? You would have had banks exploding. You would have had all the repercussions that would have fallen out of any type of fractional reserve contraction like that. They could have achieved the recession that they wanted right then and there.
It would have been shit and painful, but short.
But what do you think? I mean, it's still going to be that here within the coming year, a year and a half on the horizon, right? So like they're still trying to produce this recession. They just didn't want that recession. So what they did is they basically did yield curve control for banks. Okay, that's what the backstop facility was. It was, hey, you got all these bonds on your balance sheet, and we don't want you to have to realize the loss that they're currently marked at. So we're just going to allow you to mark them at this much higher rate, which is yield curve control, but just for them. Everybody else that's operating inside the economy, you got to still play by the rules, and you got to endure these really high rates. Yeah. Oh, you want a new house? It's still 8%. 7%, whatever it is.
You're a small business owner and you own some treasuries. They're down 30, 40%. That's your loss. Sorry.
We don't want the banks to experience the recession. We want the people to experience the recession. So we're going to play this out further. We're going to have them blow up, and then we're going to do exactly what you described, Pete. Is then we're then pump all this money back into it. And then what you're going to see, because this is where the more that they do this, the more they obliterate the middle class, the more they obliterate mid-cap, small-cap businesses, and it all gets consolidated up into a couple entities, which then has supply chain impacts, which is going to manifest all this inflation that we're talking about, because you get fragility in the system when only a couple key actors are controlling all the equity in the system. Okay, so as it blows up and they have to pump all of this liquidity back in, remember the pace with the COVID-19, how fast, like everybody's like, well, nobody's going to be working. Like we're all going to be like sitting at our house, not doing any work, and nobody's going to be driving around. But what happened to the markets, the equity markets?
They went up.
They ripped. I mean, like uncontrollably ripped. And the reason that they ripped like that is because the amount of liquidity they shoved into the market, it was like almost like a drug that was pumped into the body that had an immediate effect, right?
Yeah.
They're going to need that again for what they're brewing, because the impact when it does start to unravel is going to be felt through so many different, just across
areas,
the board, that the amount of printing that's going to have to be inserted into that and the pace, it's not just the amount, it's the speed at which they're going to have to put it in is going to be unprecedented.
So we could go into recession with equities ripping.
Shortly after. So you're gonna go into this liquidity waterfall event.
Yeah, you'll see corporate earnings start to really decrease here, and I gave you a chart of the lagging effect of the Fed raising rates, right?
Yeah.
Well, just to put a little context to why the pace. So when we're looking at the issues that we're seeing in treasuries right now in the bond market, so there's no foreign buyers right now buying bonds. They're all buying equities, which doesn't make any sense. It goes back to our credit card example, right? So who is buying it? Well, it's all these hedge funds that are buying it right now. They're going long on buying the treasuries long, and then they're covering their risk by going into the futures market and shorting that. And that's how they're protecting themselves. But they're doing it, and here's the really point of emphasis, the table stomp, right? They're doing it with 50 to 500x leverage in order to be able to soak it all up, okay?
Do y'all remember the leverage?
500x leverage.
It's BitMEX.
Okay?
Even BitMEX didn't like it.
BitMEX degens.
Because if they didn't allow them to do this, they couldn't soak up all these treasuries. And this is happening right now in October of 2023. Okay, so when you're thinking about the precariousness of this, of like where this is going, then so what's going to chew that up? Like what's going to make that unravel? It's volatility. So if we start seeing a lot of volatility in treasuries, and boy, we are right now in October of 2023.
Why would a hedge fund
that'll unwind?
Why would a hedge fund need to hedge a treasury? Like because they're getting like
it's almost like a cash and carry trade where they're getting paid short-term interest rates of 5%.
It's a basis trade,
yeah, and you just sit there and you short the treasury out on the curve, and if treasuries if the interest rates spike up, you're not going to you're going to be protected. Does that make sense?
Yeah.
So, but here's the problem. You've got this 18-month average lag. Okay, this is from the Fed and their information of what happens, right? So the block clock just flashed, and I thought it said 23,000.
So this keeps happening. So it keeps getting me. So because it's at because it flicks between the price, the spot price, and then the dollar for Sats price. But what happens is, as the 2 fades out from the 27,000,
23.
The 3 comes in. So you get 23. It's done me a couple of times.
I was like, hold on, I gotta call David. We gotta go buy some Bitcoin for my fund. So, but anyway, so you can see this lagging indicator. What's going to happen, and going back to Preston's point, is that we're going to start seeing the impact of these rate raises on smaller companies that need to borrow, that have revolving facilities, which means that the rates are higher and it's more expensive. The credit is tightening. They can't get credit. And so their earnings are down. They have to close divisions and whatever. And then they'll just start laying people off. We didn't see it this morning. What we saw this morning was a jump in unemployment, in employment numbers. And it was a super surprise. And they revised the previous numbers, which is just typical of the BLS. But so what we saw, though, if you dig into the numbers a little bit, we saw people taking second jobs. And we saw that the temporary worker rate is actually going up. And so that's a leading indicator. So it's not as rosy as everybody just jumped on and piled onto treasuries again this morning, but the bottom line is you're going to start seeing that effect. And that's when it starts to unravel, right? So that's when it all kind of starts to unravel. And that's what we're expecting or waiting, right? But at the same exact time, that tax receipts are going to go down in the near future, whether it's 3 months, 6 months, they're going to come down.
In the next year.
Yeah.
a lot.
And you've got a
They're already down 10%.
But you've got an election. When's the election?
We got election in November. So we're going to have a crisis.
Well, but this is what I'm thinking is that I'm historically a fucking terrible trader. I don't trade stocks anymore because everything that made sense never worked. And I think in doing the show and talking to people like you, I've realized I'm trading rationality. I should be trading political cycles.
That's not a bad trade.
Because if you're saying the tax receipts are going to be dropping and then corporate earnings are going to be dropping, that would be saying to you, well, I should be selling these shares. And maybe they will. And then that's the time to buy when the blood's on the streets because they're going to pump the money into the market. Is that what you're basically saying?
Pete, I would recharacterize it as you were acting as if we're in free and open markets.
Yes.
When in fact we're nothing of the sort. Right?
Yeah.
And I think that, boy, have I made that mistake for a really long time in my life. Like where I thought I was operating in this world where like these antics, these $1 trillion antics weren't happening, and that I was positioning myself as if I was in a free and open market when I wasn't.
Yeah. But let's pull on that thread a little bit, right? So you would think, okay, well, short everything.
Yeah.
Right? Like short everything, right? But you can't because you have what we saw in 2020, that V recovery because of the money printing. So let's talk through that though. But you go back to when this started. It was in 1987 when the market crashed, Black Monday, right? I wasn't even I was in high school. But I remember this and I remember everybody freaking out, right? But what happened was Greenspan came in, and you remember this from your research, but Greenspan came in and said, we will do everything to make sure that the markets don't collapse. They didn't really do anything, but they said they would, right? So now flash forward. You've got, you flash forward to 1998, right? And long-term capital management, they were putting on these geniuses who actually won Nobel Prize. There were Nobel Prize winners for the economics Nobel Prize, not that, but they won for the Black-Scholes model, the options pricing model. I mean, these guys were smart, right? But they were levered. How much were they levered? They estimate about 100 to 1. So they had $1 billion of capital in their firm. And they had about $100 billion that they could figure out on swaps on something called an interest rate trade. It was they were basically shorting volatility in bonds, right? And so when you had the Russian ruble crisis and bond spreads blew out, they got obliterated. The street started hearing about it, and they blew up in a matter of days, right? So what happened was the head of Goldman, right, was they were in a panic. So I was getting calls from this. I was in the market this time. I was in an arbitrage trading firm, and I had some of the trades on. They were blowing out. Like, what is going on here? And we knew that long term was blowing up. So we were adding to the positions. No, we had capital. We were fine. We weren't levered. But I got a phone call from one of the biggest hedge funds in Texas, and they said, hey, do you guys have any assets at Goldman? And I was like, no, we're not using them as a prime broker. And they said, well, if you have any counterparty risk with them, get out today because they're going to blow up. This is Goldman. So
they wouldn't let Goldman blow up.
The head of Goldman went to the head of the New York Fed and said, we're going to blow up. We need help. And so they assembled a room full of heads of the banks, and they basically engineered a bailout for Goldman. Okay, so this is where it started. So, well, it started in 1987. Then they put it into effect. They're like, okay, we can make sure that the banking system's okay. Our buddies over at Goldman, we got to make sure that they don't blow up because it could have taken down the street. We're talking about counterparty and contagion, counterparty risk and contagion that would have spread everywhere, right? So that's where it kind of started. And then you flash forward to 2008, and it was a full-on rescue the entire, banking industry because
and it's been that way ever since.
And it's only to Preston's point. The whole point of this is it's only compounded since because the market has learned that certain players have learned that they're big enough. They can be irresponsible with their debt loads and there's the sheer amount of credit they have. And they'll be bailed out. And so that's what the market has learned. And so the rational market would say, short everything. The real market, the insiders say, oh no, we'll get bailed out.
Well, here's the really crazy part. So everything we've talked about, this is the best G7 currency.
Well, yeah, get up the dollar pound exchange rate.
This is the best one.
No, because this
in
is
the mix.
Yeah, because look at this. This is really super interesting. So I track the dollar pound exchange rate with a lot of interest because all our contracts are priced in dollars for the podcast. Sure. It doesn't matter which sponsor we have, we price them in dollars because all the companies we deal with in dollars. So I'm in this weird position where a falling pound is really good for me.
Yeah.
And it's a weird one because I kind of don't enjoy it. But if I was talking about this the other day, so one of the first times I came to the US, as 2007, I think it was. It actually hit $2.11 to the pound. I was $2.05 when I was here, but it was $2.11. And now where are we at, Dan?
Well, you see, you know what's happening here.
Yeah, but so what happened was during the crisis of Liz Truss, we nearly hit dollar pound parity. We bounced back. Was it to 131?
Yeah, something like that.
Yeah, and now we've dropped back down to what, 121, 122. But look at the trajectory of here since 1975. It's up and down, but we are constantly weakening against the dollar.
Yeah,
always.
And that's Brent Johnson from Santiago Capital, his dollar milkshake theory that the dollar is just going to continue swallowing the world whole, and because so many contracts around the world are based in dollars. You have euro dollar market is just massive. I don't know if we can even quantify it.
I have it would be too tangential to our conversation, but a conversation about stable coins and the euro dollar market and why I think it's a really important aspect. But when we look at this, so this comparison for you in the UK is, it's losing value. It's not, but most of the world is dealing with just a catastrophic currency. Most, right? And so when we look at why so many people are using Tether and using stable coins is because they've all come to the realization, okay, like this is a dollar kind of world. And if I can get access to a stable coin, well, that's my most desirable. By the way, all my bills are denominated in dollars as the performing asset. So like, I don't want to have to become a currency, trader here. I just want to hold dollar stable coins. I don't even need to save them. I need to pay my bill at the end of the week, and I know that's going to preserve my buying power the best. So that's what I want to have. Yeah. And so half the world more has already come to this realization that they need to hold dollars because the disaster we've talked about is the best performing currency in the world right now for G7. If people are doing business with the U.S., Europe, or wherever, like you got to be dealing with dollars.
Any country who can't, a lot of countries around the world that can't issue debt in their own currency because it's devaluing so rapidly, they'll issue it in dollars. But that means they need dollars to pay interest on those. So what we're going to see at some point, and I wrote about this in my newsletter last week or maybe the week before. What we're going to see at some point here, I think in the near future, is you're going to start hearing that the Fed's opening up the swap lines again. To Preston's point, and the point is that why would they open swap lines and just dump dollars around the world? Like, if there's a shortage of dollars, what's a shortage of dollars means? It means that all of these countries need dollars, but they're too expensive, so they can't get them. So what do they have to do? Well, they have to sell their dollar-denominated assets, which are what? U.S. Treasuries. Right? Well, the Fed is trying to sell treasuries. The Fed's going to try to sell trillions of dollars.
So what does that mean for yields?
Right.
If everybody's a seller.
Right. So you can't. So yields will spike. It only makes it more expensive. Then the treasury's in more of a deficit, and they need to issue more treasuries. So what do they need to do? They need to get dollars to everybody. So they'll open these swap lines, give them dollar contracts, so they can use those dollars and not sell treasuries because they need the treasury market to remain liquid for who? For the treasury to keep dumping treasuries on the market. So
it's some game.
I think this is, so taking this to Bitcoin, right? I think that scenario with them opening swap lines, pushing more dollars outside the US and into this euro dollar market is actually extremely advantageous for Bitcoin. So here's why. When we go back to the Silicon Valley Bank situation, what happened to Circle and these stable coins that were US based? Everybody was scared as hell, right? Because they were worried that, hey, those are touching the US rails. And if they let Silicon Valley Bank fail, like all of a sudden, like these stablecoin issuers, which they're all centralized, every one of them centralized. Hell, I could make the argument that the turnkey Ethereum / Tron and all those, like the whole thing's just a centralized POS, proof of stake.
But they're centralized even at like the issuer level, like they're centralized at Circle.
They're centralized the whole way
regardless of
down.
where they are.
And you know what? People that are using dollars as a form of payment, like I'm going to hold it for 3 days and I'm paying some bill that I've got to pay. Whatever, that's fine, right? Like it's not a big deal. It's like I don't care how the people want to pay their bills, right? I'm looking at Bitcoin as a savings technology that will eventually migrate towards a payment technology as we merge this legacy world with where we're going. But back to the point on why this Eurodollar market is so important is Tether. Nobody was concerned about Tether failing during the Silicon Valley Bank situation
Because they're offshore.
because they're offshore. They're in the Eurodollar market. So as they continue to flood these dollars through swap lines out into this Eurodollar market, it gets bigger and bigger. And you have stable coins that are outside the US building stablecoin products on top of that. You're getting the entire planet addicted to the dollar. You're getting the entire planet addicted to conducting transactions on their phone. You're teaching them how to basically conduct these transactions, but when it comes to the end game and you're competing with the dollar versus Bitcoin, the dollar is debasing at least 7 to 8%, right? And with enough time, what do you think these people that are getting addicted to the dollar are going to realize, especially as the volatility as it compares to the dollar starts to subside? They're going to realize, oh, I want to hold this thing over here that is appreciating in value by 7 or 8% versus the dollar. And we're just using like past compound annual growth rate. It could go to 15% with all this inflation. Like I have no idea how much the M2 is going to blow out based on all the issues you got. Let's just say it goes to 15%, right? That they're debasing the M2 rate or it's growing. When you're comparing that to Bitcoin, that is a 21 million hard cap, that is going to be immediately manifesting itself in that, whether people want to realize it or not. It is. It's just going back to Greg Fott. It's just math, right? So I see the Eurodollar as actually being a huge asset to Bitcoin, long-term Bitcoin adoption, because you're getting off the Fed rails and outside of their control, and the bigger it gets. Now, I have concerns about Tether basically dominating that space, and there's only like 15 employees that work at Tether, and like what the stranglehold could be there. I think there needs to be more stablecoin operators that are outside the U.S. jurisdiction that are using those Eurodollars, that Eurodollar market to hold on their treasury. I see this really strange relationship, and we've talked about it on other shows, where like, who is going to buy all this? Are you going to rely on hedge funds that go 500x leverage to buy your treasuries? Or are you going to like rely on somebody that's willing to buy the short duration issuance of this because it's...
Ironically, that's now Tether as well. Like they buy more treasuries than Canada.
It is. It's the relationship that both of them didn't know that they needed to have.
Yeah.
Right?
Yeah.
And the irony of that is just wild. And so, you know, do I like Ethereum? Do I like Tron or any of this stuff? Nope. Sure don't. But I will say it is offering a turnkey solution for people to just stand up these stablecoin tokens.
But this is the point I was making when I was out in Argentina and I got fucking hammered for. I was out there and people were using Tether on Tron. That was it. I had to get dollars, right? Now, if I'd gone to the ATM and withdrawn dollars, I would have got the government rate, which was something like, say, 270 peso to the dollar.
Yeah.
But the real rate, the black market rate, is 550 because the government there is stealing, actually the 17 exchange rates in Argentina, they're stealing the difference. So I had to go to a money dealer, a grey market money dealer. It's basically like, I said, it was like going to buy weed when I was a kid. You contact this guy through WhatsApp, you tell him what you need, he comes with dollars and your pesos. And so I did the trade and I got the real amount of money. But he wanted Tether. And I had Tether. This is actually the first time in 10 years I'd used Tether. So anyway, I said to my guy, I've got it on Ethereum. He said, no, you need it on Tron. I was like, what? He said, yeah, they only accept it on Tron. I was like, really? Why? He said, because it's a $7 transaction on Ethereum and it's $1 on Tron. So I had to go into Bitfinex and sell my Ethereum Tether and buy Tron Tether. Anyway, so I'm there. I put this out on Twitter and like all these people are like losing their fucking shit, saying you're scammer, you're promoting shitcoin. The truth is, when you're there, you say to these people, it's like, no, you shouldn't be using Tether on Tron. What you actually want is Bitcoin, because Bitcoin's going to fix it. They're like, fuck off, I need dollars, and I want to hear it.
Do you want to do this or not? Yeah.
And that's the reality of this situation that's out there. Every time I go to these fucked up countries, they want dollars, and they want Tether, and they want it on the cheapest network. They don't care if it's Tron, Polygon. You can come up. If someone does it on Liquid cheaper, they'll use it.
This is the crazy thing about all of these Ethereum, Tron. The only use case that I've been able to find are stablecoins. Mm-hmm. Like it almost seems like the whole reason those things have kind of manifested themselves is to provide a turnkey tokenized dollar for the world. And what I also find interesting is when you look at their proof of stake model and how they're basically doing the exact same game as the dollar and all these fiat currencies, they're doing the exact same thing, right? Because they've got to pay the people that are staking their coins, that yield, whatever that percentage is going to start to compete with treasuries. Okay? So the irony of all this is just kind of mind-blowing. But when I look at the two worlds that we got this legacy city of finance, right? And then we have this Bitcoin, this whole financial system that's going to be built on top of Bitcoin. You have to have a road that connects these two in order to transition over to what this new world is going to be with sound, stable money. And that's, I think, a key component of the architecture for that bridging to occur is the tokenization of dollars.
But let's make it clear, this is minuscule compared to what the overall euro.
But growing and still an important, like if we're trying to get people into this world of Bitcoin to make them understand, our lowest hanging fruit are people in these markets who want dollars and they get on the blockchain. It's kind of like blockchain Gresham's law, in that they're actually transitioning through, and and Binance, for whatever anyone thinks of them, have done this incredible job where they're everywhere. Every country you go into, people are using Binance. They're not using River. They're not using Swan. They're using Binance.
We should be clear that's because they're just a massive shadow bank and they don't care about the regulation.
It is that. But it is also, the fact is, they've gone into every country and they've spent money on marketing and putting people in these countries who are working. You go to Lebanon, there is a Binance team there, right?
Yeah.
And so what's happening is these people, they're getting their Tron dollars and they're selling it on Binance. But whilst they're there, they're seeing Bitcoin. Like it's there and it exists. And so that's our lowest hanging fruit. Yeah. Trying to go to one of these countries and try and get them to go from the lira to Bitcoin is really hard, and a lot of them can't even afford it. Yeah. It's a luxury.
So when you look at the average person, they don't even have the capacity to save, right? They just need to make sure that the dollar that they just earned is going to still be worth $1 4 days from now, because the bill that they owe 4 days from now is in dollars.
That's right.
Yeah. Right? And so they need to hold something that isn't worth 50 cents or 90 cents in 4 days from now.
Which is why Bitcoin's a luxury.
Bitcoin is still deep into the savings. If we're looking at the transition of this, right?
But think about it.
Still deeply Bitcoin is a savings technology,
long-term savings.
But the weirdest point of this, being able to save money is now a luxury in the majority of markets in the world.
Yes.
Yeah.
Okay.
Yes.
So the poverty.
This is what people don't understand, that nearly over 700 million people live on less than $2. Well, $2 a day. They can't have Bitcoin.
Yeah.
Wow.
So when I was in Lebanon, I went to this town called Zahi, and I went to see this family, and it was a family of 5, and it was probably the worst, the most horrific example I got to see. Family of 5, 3 children. One child's 14, has Down syndrome. Another one's 27 with a mental age of 3. The third son was the one who works. The dad can't work because he's deaf. He used to do construction. There's no construction anymore because there's no investment because they've killed the currency and they stole all the money out of the banks. The mum has to look after the 2 children. So this one kid, he's 19, my son's age. He goes to work every day. He works in a factory and earns $100 a month. So that family of 5 is living on $100 a month and then whatever handouts.
Wow.
And that was a really extreme example. But I said, what is it like around here? He said, well, it's all versions of this. It might be a family of 3 with one person working. Or it might, if you're lucky, it's a family of 3 and 2 are working. They've got $200 a month. But everything is also getting really expensive in that country. And so there is zero chance where these people can save. Bitcoin's not going to fix this for them. Because Bitcoin may raise up the world, but it's not going to fix it. What's going to fix for these people is getting money into the country, which is dollars, which can build up an economy. But Bitcoin is a luxury for all of these people.
That at this point, absolutely.
Yeah.
Until it just becomes a fast, simple payment. Or exchange,
Stable.
Stable. Then that's it. Yeah, and it's going to take it to get to many trillions of dollars in assets to get there.
One thing I do think is interesting. I wonder if we are, politicians are incentivized to win votes, and historically they've done it by promising to do different things with taxes and or spend money on certain things, right? But there's a few signals I'm starting to see now. So Javier Milei, who won the primaries in Argentina, the libertarian guy, said the problem is government. That's it, and that's his campaign. The problem is government. So I'm going to massively reduce government. I'm getting rid of the central bank. I'm going to dollarize. And he won the primaries. He's probably going to win the election. In the UK, Rishi Sunak, the Conservative Party, isn't a traditional Conservative Party now. It's pretty much a centre-right party. Big government, surveillance state. They've started to radically change their policies recently because they know they're going to lose the election. And he's coming out and saying inflation is a tax. So he's basically admitting
if the BBC will let him talk.
Yeah,
but he got it out. But he's basically admitting. But even
and now
help me. The removal of the Speaker of the House.
Yeah,
wasn't that to do with spending and the?
It was in Ukraine.
Yeah. And so as you said, like Wall Street is starting to understand we're fucked. What you said a year ago, I think some of the politicians are starting to realize that they need to get ahead of the curve themselves.
Yeah.
And so,
but they're still, but remember, they're all still running on getting reelected. Like they're all that's their drive, the driving force. You have to look at the incentives of the system. The system is broken. The system it's not fixable. It's not repairable. You have to have a new system. But they're using that. It's just now it's their party line now that they're like, oh well, we're going to fix the government. It's the same thing as Trump is going to come in and drain the swamp. No, you're not. But it's just not.
But what I think the point I was getting to is I think we're starting to see the opportunity for different things as revolutionaries. Like for whatever you think of Bukele, and he's certainly not perfect. There's plenty of criticism you can label at his door, but he has rejected the traditional economic model.
Yeah.
The country has massive investment going into it. Like big companies are investing there. Tourism's up, crime's down.
Yeah,
he's done something.
Yeah, so you're saying we're starting to see factions in the traditional the current traditional system.
Well, and developing markets where it's easier to make a difference.
Sure,
Javier Milei, completely outside of the. You're not going to. You're going to struggle in the US, but you say that RFK is going to run as an independent now, right? Yeah. He's going to split the vote. He's going to do a Ross
really
Perot.
Interesting.
That could be really interesting for a number of reasons. And the way the way that elections work here is the electoral college, right? If you don't get a certain number of votes, then from the states they have their amount of votes depending on the size and population, right? And that's why Texas has so many votes and California. But if he splits the vote,
it's going to get
really interesting because then it could end up that nobody gets the 270 electoral votes
then
to
what
win.
Happened? Has it ever happened? What happened with Ross Perot? Didn't he get like 30% of the vote?
No, he got enough that it was an eye opener, but it was not. It was.
But why did he step down? Didn't he? He pulled out.
I can't remember what the situation was, and
But so there's never been a situation where somebody hasn't got the electoral votes?
Well, not in modern times. Not in.
Do we know what will happen?
I don't. Yeah.
Will everyone go,
what happened?
What do we do?
We're typical Americans.
We don't know what to do.
The answer.
This is the point. Is that this is what would happen? Is then it goes to each state which would have a vote. So instead of going to electoral college, so then it could get interesting. So Larry Lepard, we were talking about yesterday. He was like, I think that Kennedy could win because he could split the vote enough that we don't get to the 270, and then we have to have kind of a runoff, and then each state could just choose.
And he could win as an independent.
Yeah, it's possible. Is it likely? I think it's highly unlikely. Larry and I differ on this a little bit, but
to split the two parties, though?
Absolutely, it's absolutely possible.
Split the two parties would be interesting.
Yeah. So, but he's not. The issue is he can't win outright because he can't get on stage. He can't even get in the.
Yeah, that's part of the problem.
He can't even get in the debates. They won't let him because it's a two-party system. They're like, no, sorry.
That might work in his favor.
What's that?
That might work in his favor.
It may
eventually.
Yeah, but
Trump hasn't even showed up for a debate yet.
And he may be the Speaker of the House. So
yeah, I heard about that.
I don't know.
Yeah, but the Speaker of the House now is a Bitcoiner, right?
The acting speaker, you're saying? I don't know.
Yeah, no, he's pro Bitcoin.
Yeah,
he's pro Bitcoin.
Let me just make something really clear. Politics are not my specialty. I have no idea.
Hold on, you told me a long time ago to stay out of it.
But stay out of politics. He's only there temporarily, but we don't know who's going to and ultimately be the speaker. But all the point of all of it is a system is just. Jeff Booth says over and over and over again, you have to look at the incentives in the system, and that's what's got to change. It's not individual. So when people say, "Oh, you've got to be really careful about who you vote for," and sure, this, I mean,
not on this subject.
That's it. This is the problem.
Yeah.
The problem is this is not going away.
Neither party can fix this.
Yeah.
And neither party cares to. They just want to get reelected. So you go this past spring, all of that pomp and circumstance around the debt ceiling and how the Republicans don't want any more spending and the Democrats need to take care of their constituents and got to take care of the poor. Well, what happened? We just kicked the can down the road and said, we won't have a ceiling for now. We just won't approve any new spending. And then what happened? Well, we get up a few weeks ago and, it's like, oh, God, we got to come up with we got to agree on a budget. And so what'd they do? Well, we can't agree. So we'll just kick that can down the road for another number of weeks. It's like 16 weeks or something. We're like, okay, well, we're good for now. And what happened? The debt went up by $500 billion in the last 2 weeks.
Just to give people context. So DOD, the whole Department of Defense, I think their budget's $700 billion.
Yeah.
Right. Annualized.
Yeah, the debt interest is higher.
So when you look at the interest, or I'm sorry, the last 2 weeks of $500 billion, and you think about you remember the pictures that you see, the memes of the aircraft carriers with all the jets and all the people on board and the specialized training to fly. Think of all of that across. I mean, people that aren't here in the States have no idea how many military bases. You go down to Texas, there's 7-8 miles of tanks, literally 7-8 miles, multiple rows.
You drive down that, it's impressive.
I think the name of the road is Hell on Wheels, right? Is the name of the road. The sheer size of this, paying every single salary for all of these people is what they've almost added in the last 2 weeks. Yeah. To that debt clock.
Where's that come from? Where's that
They should have just spent that on Bitcoin.
What do they spend that on?
What are they spending it on?
Yeah, the $500 billion has been added.
Who knows?
All the promises, everybody that just these programs and just everybody wants a handout. Everybody wants some type of compensation, and the reason why is because they're refusing to allow deflationary forces to actually take effect into the economy, and everybody's been turned into a good little debt slave inside this country. Nobody can retain any type of savings. It's just borrow more, get back to work, get back to work on your second or third job.
Yeah.
And eat the bugs.
because there's no way you're going to pay this new payment on that car, which is now $2,000 a month, or what are some of these car payments?
The average is over $1,000.
What?
It's nuts.
What?
Yeah,
It's
crazy.
insane.
It's insane.
$1,000 a month on a car.
Yeah, like it's like
For 7 years or whatever.
The number of people
term they
paying
took out.
$1,000 a month for a car is just insane. And remember, but don't
Because
forget,
the rates are so high.
And
the cars are 70,000 or whatever
yeah,
per vehicle now.
Like you can't get a car for less than can you get a car
Yes.
for less than 30,000 now? I think there's one
God,
car.
no.
There's one car.
If you're buying a new
market.
car, you're 60, 70,000.
That was higher than the payments when I had my Aston.
Yeah. Like no,
And what? They driving a Prius?
if you want a truck, just a Ford, just a Ford 150, it's over $70,000.
Yeah.
For a truck.
Sake.
So, yeah, the point is that going back to what Preston was saying about the budget for the military is over $700, and what your comment off the cuff was, and we're paying more in interest. Yes, we are. We're going to pay. We're on track to pay just under $1 trillion on interest on that debt.
Yeah, your interest is like our
And
GDP.
it's only getting worse because rates are going higher.
That's the mechanics of a Ponzi.
Yeah, because as we're gonna have somewhere around 42% to 44% of treasuries are going to mature in the next 18 months. And those treasuries, and a lot of those are T-bills, and a lot of them are short term that we've issued in the last few years, but that interest rate is well below half of what it is today. So all of those treasuries that are maturing, the payments on those are going to double, and that in the next 18 months. And so the payments on so as we are growing the debt, as our tax receipts are coming down, our interest payments are going up, which makes the debt grow, which just creates a larger deficit, which creates the need for more debt, which creates the need for more borrowing at higher rates, which creates more debt, this is literally
spiral.
I get it, Bernie Madoff. I know where this is going. All right. How to prepare? Is it just hard assets?
Okay. How to prepare? Yeah. Well, you just have to expect. Going back to what Preston said, is like we cannot get out of this. So what are we going to do? We're going to have perpetual high inflation. They're not going to admit to it. They're going to say, "Oh no, inflation's 3%," and we're going to start hearing that we've tackled inflation. It's great, even though we're seeing numbers that are in the 3% because we're above the neutral rate, which means that it's enough of an interest rate. The interest rate is high enough that it's tightening, economically tightening, right? So they're going to say, we're good. Inflation's really going to be running at 4, 5, 6, 7%, and they're going to say it's around 3%, but they'll say 3 to 4% that's good enough, because they think that all they care about is getting away with it. So if you hear 2% inflation, you're like, it's just 2%. If you hear 4% inflation, you're like, 4%. If you hear 5, 6, 7%, you're like, hold on a second. You're going to take 7% of my money. I've got to argue for a 7. You would have to argue for a 7% raise with all your sponsors every year just to keep up. Mm-hmm. And so what are they doing? All they're trying to do is create more GDP, gross domestic product, in dollar terms, which are nominal dollars. Those are just how many dollars are out there, how much we're creating, how much we're taxing on that. And even though the dollars are worth less, we're gonna create more of it in order to pay down the debt from before. And so how do you prepare for that? How do you prepare for inflation? You have to own exactly what you said.
Things that don't you can't inflate.
Gold, silver, Bitcoin. The best to me is Bitcoin. It's not even close. But it's still pretty volatile.
Yeah, but you know what? Strangely for me, right now, actually, I've started to think because I have to have pounds to run my business. Mm-hmm. But with my business bank account, you can actually have a dollar account. I've actually started to think I'm going to start leaving some dollars in the account. Mm-hmm. Because it just feels like the pound is on a continual slippage against it.
Well, and that's interest rate parity in the short term, which just means that if our interest rates are higher than the UK interest rates, and UK and Europe their productivity is dropping rapidly, and so they're in a period of stagflation where your production is going down, but the costs are going up, but they're going to lower rates. And so if the interest rate is lower there, you can borrow pound and buy dollars and buy treasuries and then have an agreement to pay back that borrow rate. And so you're moving money out of the pound into the US dollar because of interest rate parity. That's it. Our rates are going to stay high. Clearly, the market is saying rates need to be higher because, oh my God, there's so much debt coming onto the market. We need higher rates. We need to be compensated for this risk. So.
Okay. So when we get back in a year,
so happy Friday.
Let's have a prediction when we're here next year. Pacific Bitcoin, what's that newest national debt number going to be at? We were at it was August. It was 30.75. Well, it doesn't matter. Where do you think that number will be when we're here next year?
Well, it's going to certainly be over 35.
Yeah, I mean that's easy.
That's easy. I think
I'm going to go
30. I think it's. I would say that. Look, if you just do the numbers of what we're running as deficits, I think we're going to run over $2 trillion of deficit, which would put us in 1 year. It would put us at I think it's going to be close to 37 trillion. But that's above and beyond the numbers that the Treasury is telling us today.
Yeah.
So just to be clear, that if you listen to the Treasury, that's going to be like 35.5. Or if you listen to the Treasury, that's going to be 35. That's what they're saying. It's going to be $1.5 trillion. But I think it's going to be triple that, because of effects of the market. I think that we're going to hit a recession before Pacific Bitcoin next year.
So before the election.
Yeah. So we're going to have the bottom drop out. So I think it's going to be above 30. It's going to be well above 35, probably 36 to 37. That's my guess. What do you think?
I would agree.
All right. Well, we need to get back to the conference. James, where do people get your newsletter?
So just go to my Twitter handle. It's on there, or just jameslavish.com. And it's called The Informationist. But also, we've launched our Bitcoin Opportunity Fund, and I've been working super hard on that. So I just want to make it clear that everything we're talking about, we see massive opportunity in the Bitcoin space, massive. So there's so many companies we're talking to, they're growing and they're doing well at the exact same time that the market is kind of collapsed on them. And so it's difficult to raise money. So valuations are way down. So there's still so much opportunity out there.
And when are you launching your podcast?
Danny had to talk about it.
Yeah, you should. I told you yesterday, I want your newsletter as a podcast so I can listen to it rather than read it.
We'll talk about it.
We'll talk, yeah. Preston, where do you want people to go to?
I'm active on Twitter, and I have a podcast called We Study Billionaires, and I cover Bitcoin every Wednesday.
Hey, look, if we keep going through inflation, you're going to have to change that to We Study Trillionaires, because everyone's going to be a billionaire. It's like, you're studying us?
You should do that. You should cross it out.
It's in sats now. The show is, if you have a billion sats, that's what it's.
Just have it crossed out and have
We study them.
There. Yeah.
All right, guys. Well, look, thank you. I think we're going to do this again in a year, see what fucking insanity we're in. Love you both. Thank you so much.
Thank you, guys.
Thank you, guys.